Hi there and welcome to this video, which is the final video that I've made about building my own hedge fund, and this video is all about pulling it together. But before I start, most important is it's important for me to say that I'm not a financial advisor. I have no qualifications in the world of finance. This is just about me. It's what I'm doing, and so I'm talking about what I have done, what I'm doing, and what I'm going to do in the future. So it's not about what you should do. I'm not saying that you should do any of this. If you choose to do some of it, you must do it at your own risk. So this isn't financial advice. The videos that I've done up until now have been talking about the different asset classes that I invest in, and the reason why I do that is to try and reduce my risk, because I think it makes sense not to put all of my eggs in one basket. So one of the most important things that I like to invest in is businesses, and the way that I do that is by owning shares. It's possible to buy shares, of course, in a single company, but that depends, to do well, that depends on that company doing well. So it's possible to buy shares in companies all around the world and through lots of different companies through something like an investment trust or an exchange traded fund. So that's my first asset class. The second asset class is property, and that can be done in much the same way through an investment trust or an ETF. I like to buy commodities through an investment trust or an ETF or through commodity companies, and I like to also own some bonds as well. And there are two other asset classes. Cash is an asset class, and I think it's great to have some cash in my ISA, and it's good particularly when there are bargains to be had. If I haven't got any money available to invest and suddenly something becomes very cheap and seems like a really good idea to buy it, it's good to have some cash there. And the other thing that I like to hold is gold. Gold is an asset class that has been considered valuable by people for many centuries, and I don't think that's going to change in any great way. And I tend to hold gold either through the Royal Mint or through an online gold dealer, and it's possible to hold gold in the UK, and it's possible to hold gold abroad as well. And there are perhaps good reasons why people should consider having some investments outside the jurisdiction of their own country, because governments can get greedy. Okay, so I like to do all this through an ISA, an individual savings allowance, because it's tax-free. I don't want to pay taxes on my investments either along the way or at the end of the day. So I like to trade primarily or invest primarily through my ISA. But I don't do the gold trading in the ISA. Now, in the video about gold, I mentioned that if you buy bullion through the Royal Mint, it's possible that because it's currency, one doesn't pay any tax on it. Well, there's no interest claimable on bullion, and there's no capital gains tax payable on currency. So so that's worth thinking about. It's worth thinking about having gold, I think, outside of my ISA. Now, the annual ISA allowance is £15,240. So that's how much I can put into my ISA in this current financial year. And if I divide that down into a monthly amount and then split that amount into the different asset classes, so 5 asset classes that I'm going to have inside the ISA, including cash, that comes to £254 per asset class. Now, I like to invest monthly, because if I'm drip feeding money into my investments, it means that I'm not going to put all of my investments into one asset class and then find that the asset class suddenly crashes the next week, and suddenly I've made a massive loss on the investments that I've made. So I like to drip feed money in, and anyway, like many people, I work and earn my money on a month-by-month basis. So so mostly that's how I get my money, and so it makes sense for me to invest monthly. And so I do that. I set up investments with my ISA account, and in the trading platform that I use, I can set up some regular investments so that the things that I want to buy are lumped together with the things that other investors want to buy, and so the dealer can then buy them very cheaply on my behalf, and I can pay as little as £1.50 per trade if I'm doing a regular investment. So that makes it very inexpensive. If I know what I'm going to buy and I'm going to buy it every month, I can just set it up as a regular investment, and I don't have to actually make the trade myself. I can just leave it to the broker to do that, and it makes sense to do that. Now I can do that if I'm buying things that are in the FTSE 350. So if they're companies that are the 350 largest companies in the UK, if they're in that group, then my broker knows that they're going to be buying that for lots of other investors, and so they'll buy those shares or investment trust things for me very cheaply. So there's an example here. So I could set up to buy Scottish Mortgage Investment Trust. So this is, remember from the video about buying shares, this is an internationally diversified investment trust that buys shares in companies that it thinks will do well in the future. It's the UK's largest investment trust. So I can set up an order to invest £254 per month in Scottish Mortgage Investment Trust. Nice and easy. I'm spreading my risk geographically and spreading it through different types of shares as well. Now, for property, another asset class, I can invest in TR Property Investment Trust. This is a large property investment trust. Again, you've heard me talk about it in the video about investing in property. It owns property in the UK and it owns property in continental Europe. I can set up £254 to be spent on TR Property Investment Trust shares per month. Vedanta is a large commodities company, one of the FTSE 350's components, and it has multiple commodity operations going on: mining, drilling. It produces all sorts of metals and oils and gas and so on. So it's a huge commodity producer, and because it's in the FTSE 350, I can set up a standing investment of £254 per month. I can do the same with bonds. Now, if you've watched my video about bonds, you'll know that I have some reservations about bonds, but in spite of those reservations, I still think it makes sense to own some bonds, and I use Personal Assets Investment Trust, or have used them as a kind of proxy for bonds. They have a lot of bonds in this investment trust, but also they have other things that make it perform a bit like bonds perform. It gives a good steady return. It's not a stellar performer, but it tends not to fall through the floor either. Now, because the share price of Personal Assets Investment Trust is 254, is bigger than £254, I can't set up a payment of £254 to buy this particular share. I either have to just buy that manually myself when I've got enough money in the account, or I have to actually tell the broker that I want to invest more and then occasionally just cancel the order. So there are a number of ways of going about that. So the other asset class is cash, so I allow £254 per month to sit as cash in my ISA. Now the gold, as I said, I do separately, and I just pay £254 per month into the company that I'm using to invest in gold, so that I'm investing the same amount in these different asset classes. And then what I've done over the years is I'll change the things that I'm investing in. So I won't always put money in Scottish Mortgage Investment Trust, for instance, forever, because who knows, the management there might change, its performance might dip, and it may do badly. So I think it's a good idea to invest in a variety of different investment trusts, in a variety of different property companies or ETFs, in a variety of different commodity trusts or ETFs, and in a variety of different bond trusts or ETFs. So I'm not going to keep this formula the same year on year. I'm going to change it from time to time, just as a matter of expediency, so that I just keep a nice spread of risk as the years go by. Because remember, for me, this is a long-term investment. I'm not doing this to try and get rich next year. It won't work like that, because I'll have some assets will do well and some assets won't do well. So this is a long-term investment strategy. The important bit now, this is crucial, because I'm investing in different asset classes. What's going to happen is that the asset classes will perform differently. Some will do better than others, and so what I'll find is that at some point part of my portfolio will have done very well and part of it will have done quite badly, and we'll see a graph of this in just a minute. So what's important is that when the portfolio starts to get a little bit too out of balance, is that I sell some of what has done very well and I buy some of what's done very badly. And the important thing about this is that it makes me sell when things are doing well, in other words selling high, and it makes me buy when things are low, in other words when things are doing badly. Most private investors do the opposite. When things are going well, they'll buy when things peak, and then when they start to drop, they'll sell them again. But what I'm doing with this strategy is rebalancing, and so I'm selling high and buying cheap. Let's have a look at a graph. So here we've got the different asset classes, 5 different asset classes. I haven't put cash on here. Let's see, in recent times, the blue line, this is the Scottish Mortgage Investment Trust. So if I'd bought these different asset classes 5 years ago, this is a 5-year chart by the way, so if I bought into all these things at the same time and put the same amount of money in them, the Scottish Mortgage Investment Trust will have done the best. Okay, that will have gone up 140% in 5 years, so that's done really well. The next best asset class would have been property, or the TR Property Investment Trust. That's done nearly as well, it's gone up 110%. My bond fund, although it's not completely a bond fund, personal assets here has gone up 20%. And here we've got, this is gold. Gold has actually gone down a bit, it's gone down 10% over a 5-year period. And the worst performing asset class has been commodities. This is the share price of Vedanta, which has done the worst. This has gone down 80%. So if I'd bought all these different asset classes 5 years ago, these two would have done phenomenally well. These two, you know, would have balanced each other out pretty much. This one would have done badly. Now, some people would say, what's the point in doing that? That means that you're not actually going to do anything. But it's not true. Look at the figures. The Scottish Mortgage Investment Trust has gone up 140%. Property has gone up 110%. The worst performing asset class has only gone down 80%. Okay, so it's gone down half the amount that's gone up. So what I'm saying is that overall, in balance, everything's gone up. Now, if I were to have this as my portfolio right now and I were to rebalance things, I would be selling some of these two probably and buying certainly some of Vedanta Resources and possibly some gold. Probably this would be about the same. So selling some of these, selling high, selling when they've done well, to buy low, buying cheap. Okay, and that's the whole point of this. So then essentially we're bringing everything back to the same starting position, and then, you know, going to review things somewhat later. I like to review things every 6 months, certainly once a year, but possibly every 6 months. And the nice thing about doing this is that I can set this up, have the money going into my ISA, have the trades planned and booked with the broker, and then forget about it. How good is that? Now, I'm not going to worry about stock markets rising and falling. I'm not going to worry about the gold price. I'm not going to worry about property crashing. I'm not going to worry about bonds performing badly or performing well. I'm not going to follow any hot tips. I'm not going to think, oh, the latest tech company is this, and they're going to go stellar, and I'm going to invest in that. With this investment, I'm not doing that. All I'm doing is making a hedge fund, which is going to cope with any situation, really. And if my business is doing well and I've got more money than I can put into my ISA because I've used up my allowance, then I can do the same in a pension fund. Now, there is lots of debate about whether it's best to put money into an ISA or a pension, but for me, I like the idea of putting things into an ISA because it's completely tax-free all the time. So when it comes to basically accessing all this investment in years to come, anything I take will be tax-free. Whereas if I've put it in a pension, I can take at the moment I think a 25% lump sum tax-free, but then the rest of what I take is taxable. But there are some advantages to having things in a pension fund as well, and one big advantage is going to be avoidance of inheritance tax, because the tax rules have changed on pensions just recently. But again, don't think I'm giving you advice about ISAs and pensions. You've got to make up your own mind. But personally, I start with putting my money in an ISA, and if I've got anything left over, I'll put more into my SIP, into my pension. But you know, I think it's better that way around. It depends, you know, how good you know, one is with not spending the money. Some people, if they suddenly see a car they fancy and they know they've got 20 grand sitting in their ISA, they might be tempted to take the money and buy a Porsche with it. That's not my style, but so I know I can deal with that. So you know, everyone has to make up their own mind. And now I think the trick is to remind myself that when things are going badly, when markets are crashing, that's good. It means that because I'm buying monthly, I'm getting more for my money, and I just have to keep going through thick and thin. I just have to keep going. I don't worry about the markets, because I know I'm diversified and that my strategy will deal with all scenarios. I do have some strategies for what happens if things go really pear-shaped in the financial markets. But you know, what we're talking about here is the kind of ebb and flow and the ups and downs of markets. But of course, you know, markets can go terribly wrong, you know, and we can have massive financial crises, of course. That's really not the subject of what this is all about. You know, that's really a whole different video, and that's something I'll perhaps do for you if you're interested. That's the end of the series, and I hope you enjoyed it. You know, it's not advice from me to you. I'm just telling you about what I'm doing. I'm telling you about what I've done, what I'm doing now, and what I plan to do in the future. And I haven't invented these ideas. You know, I'm not a sort of financial whiz kid. You know, mostly it's stuff that I've taken from other people. And there are a couple of books I'd really recommend you read. The Ivy Portfolio. So this is by a couple of people called Faber and Richardson, and they looked at the investment strategies of some of the American universities that have massive endowment funds that have done spectacularly well, and they've had a look at how they've done that, and they've made some suggestions for the private investors. So that's really worth buying. The Ivy Portfolio by Faber and Richardson, and a more simple book, a very quick read, is Fail-Safe Investing, Lifelong Financial Security in 30 Minutes. This is by a guy called Harry Brown, who is involved with an American investment program called the Permanent Portfolio, and that's a very quick read, and it basically works along the same ideas as the Ivy Portfolio. He talks about 4 different pots. I've talked about 6, so you know, maybe I'm making it more complicated than it needs to be. But you know, really worth reading both of those books. And if you want to make some investments, you know, make up your own mind about what you're going to go for. But this is what I do. I hope you enjoy it. The main thing to do is not to get overwhelmed by information and sort of have paralysis by analysis. You know, most people are so terrified of anything financial that they don't actually do any investments at all. And you know, I would certainly caution against that. At least, you know, if you're going to do something, do something. Don't just talk about it and end up with no investments, you know, in years to come. Because essentially, this is about trying to, you know, create a healthy financial future for ourselves and our families. So you know, we all have to do something. So bye for now, and hope you get on okay.